A lot of people tell you to invest in the market, but rarely does anyone stop to explain what do they mean by that. In this video, I'll pull back the curtain, remove the veil, peel the layers of the onion. You get what I'm saying. I will tell you everything you need to know about investing in the market, what does that mean, and what are your choices. So investing in the market is often advertised as the most sensible thing for the new investor or for someone that wants to invest passively and doesn't want to make predictions. And it makes sense, right? You simply buy a little bit of everything, chill, and go about your day. Well, the problem is that it's not that simple. There are four main types of strategies referred to as investing in the market, and each of them has its pros and cons, which almost no one talks about. And the biggest problem is that 3 out of those 4 require you to make an active decision and a prediction about the future, even though this is not how they are advertised. And so you might be thinking that you're totally safe and perfectly diversified, when the truth is that you're making predictions without even realizing it. Let's start with the first way people usually invest in the market, by putting their money in the S&P 500. This is the oldest index and is comprised of the largest 500 companies in the United States, ranked by market capitalization. There are many ways you can invest in it, but for the purpose of this video, I will simply pick one of them, the Vanguard ETF VOO. For my European friends who don't have access to that ETF, you also have a lot of options to choose from. Here is the biggest and most popular one, the iShares Core S&P 500 UCITS ETF. The S&P 500 has returned on average a little over 10% since 1957 and the even more attractive 12.6% in the past 10 years. When it comes to volatility, using standard deviation and beta, which are both metrics used to assess the fluctuation of an investment return and price, we can see that for the S&P 500 for the past 10 years, they are 15.63% and 1 respectively. Now, the beta metric is normal to be 1 because it is a measure of volatility that is compared to the S&P 500 index. A number higher than 1 means the investment is more volatile, while a metric less than 1 means it's less volatile. Since the S&P 500 cannot be more or less volatile than the S&P 500, that would be a kind of inception. It's always going to be 1, but we will use it for our next ETFs. The fees for owning this fund are as low as it gets, with Vanguard charging 0.03%. And now let's look at the top companies. The top 10 ones make about a third of the fund at 32.5%. We can see the familiar USA big tech corporations, plus Eli Lilly and Warren Buffett's holding company Berkshire Hathaway in them. So as you can see, the fund is pretty top heavy, and for every dollar you put in it, about 30 cents will go to these top 10 stocks. Now, here it is important to understand that the beauty of the ETFs is that they are self-rebalancing and cleansing, so to speak. The top 10 companies right now have nothing to do with the top 10 companies 30 years ago and will probably have nothing to do with the top 10, 15 years from now. I found this wonderful graphic at the website personalfinanceclub.com that shows what the companies were in 2000. As you can see, the only one that remains today is Microsoft. And looking back at the index in 1973, it is totally unrecognizable. Not a single one of them is in the top 10 right now. As you can see, this is the benefit of investing in index funds for the investor who doesn't want to try to constantly predict which stocks will outperform in the next decade. Lastly, looking at the sectors inside the S&P, we can see an obvious domination by the tech sector at 30%, followed by financials and healthcare with 12% each. Alright, but is the S&P 500 the market as a lot of people claim? Well, not exactly. It is the biggest 500 companies in one of the countries. Okay, how about all of the stocks in this country? Let's examine this choice. For this purpose, we are going to use the Vanguard Total Stock Market ETF VTI. The fund represents 100% of the investable USA stock market, including companies of all sizes, large, middle, small, and even micro. This ETF was established in 2001 and has returned 8.58% per year since then. For the past 10 years, the return has been 12% annually. I will later compare all the ETFs in a spreadsheet for the sake of clarity, but you can see how that closely tracks the S&P. The beta and the standard deviation stand at 1.02 and 16% respectively. This shows that the fund is a little more volatile than the S&P. The fees are as low as they can be at 0.03%, typical for the Vanguard ETFs. Unfortunately for all the investors from the European Union, there isn't a direct equivalent tracking the index behind VTI. However, by the end of the video, you will see this isn't such of an issue. Looking at the top 10 companies, they are the same as the ones in the S&P 500, which is normal since both ETFs are market capitalization weighted, meaning that the biggest companies will be at the top. However, their weight is about 4% less, standing at 28%. The obvious reason for that is that VTI includes a lot more companies, over 3,700 currently, and so part of the percentage goes to middle and smaller stocks. When it comes to the sectors, the picture is similar. Technology leads with almost 29%, while healthcare and financials follow with over 12%. Okay, but are all USA stocks the market? Isn't there anything else we can invest in? I wouldn't say so. Even though I love the United States and I think it's one of the greatest countries to ever exist, it's only 4% of the world's population and 25% of the world's economy. There's a big world outside of it. What about the rest? Well, let's explore it. Before I do that, if you want to see my top 4 stocks and ETFs for the current economic and geopolitical environment we are in, you can get the free report from the link in the description. As I already mentioned, the USA has been a big driver of the stock market returns in recent years, and one of those 4 stocks is an ETF that is concentrated on the USA. However, it's not the standard S&P 500, VTI, or some other broad fund, but a rather concentrated one with a unique strategy. Again, you can get the report in the description. Alright, let's now see another candidate for the so-called market, the biggest stocks from the developed world. It is the MSCI World Index. It has almost 1,500 large and mid-cap stocks from 23 developed countries and covers roughly 85% of the stock market in each country. One of the biggest ETFs that tracks the index is iShares MSCI World ETF by BlackRock. The ETF was created in 2012, so we don't have as much data as for the S&P or the VTI. For the past 10 years, the annual return has been 9.62%. The standard deviation and the beta are 15.41% and 0.97% respectively. Here the fees are higher, standing at 0.24%. Now, when it comes to the portfolio, if we look at the top 10 companies, there shouldn't be any surprises. Basically, aside from Chase, the same old companies dominate the index as well, and they are all USA based. Here, however, the fund is little less top heavy than S&P or VTI, as they represent 23.5% of the ETF. In terms of sectors, nothing revolutionary. Again, tech is leading, followed by financials and healthcare. And by the way, for all my European friends, you have the exact same ETF by BlackRock available to you. Now, what do we have in terms of the country composition? As you would expect, the USA dominates, with 2/3 of the ETF being in American companies. Next is Japan with 6%, followed by UK, France, Canada, and the others. So the fund is still obviously very USA heavy, which is logical because the biggest companies are there and it is weighted by size, but you also have additional roughly 1/3 of the fund with exposure to different countries. A bit later in the video, I will give you my opinion on what type of investors this is suitable for. But for now, let's see the final option, because in my opinion, not even the MSCI index can be treated as the market. So let's check the broadest ETF you can invest in that incorporates the biggest amount of companies possible. This is the Vanguard Total World Stock ETF. This ETF follows the FTSE Global All Cap Index, which includes companies from both the developed and emerging markets and of all sizes. The fund has returned 8.5% in the past 10 years and 7.5% since its creation in 2008. The standard deviation is 15.35% and the beta 0.96. The fund has a low expense ratio of 0.07%. When it comes to the top 10 holdings, here they represent a little over 17% of the ETF, the least of all the others. This is to be expected as this fund has almost 10,000 stocks in it. Think about it. One ETF and you have 10,000 companies in your portfolio. It's astonishing what modern technology can do. The majority of the top 10 will be the same as in the other funds, but I want you to notice one difference. The 10th company is Taiwan Semiconductor Manufacturing. Here you can see how the fact that it includes emerging markets shapes the ETF. This semiconductor manufacturing giant is domiciled in Taiwan, which is classified as an emerging market. Because of that, you will not see it in the ETF that includes the stocks from the developed world. When it comes to the sectors, obviously technology will be leading again, although with a lot less of a percentage than the S&P. Financials come second, and after that, unlike the other three, we see that industrials take the third place before healthcare. These things show you how the inclusion of the stocks from the emerging markets changes things compared to the USA-centric ETFs or the fund with only companies from the developed world. When it comes to the countries breakdown, the USA again obviously leads with almost 58%. Then we can see a bunch of countries from the developed markets, which we saw in the MSCI World Index. But notice that here we have China and India included, which are part of the emerging market economies. For all the Europeans, you can get the exact same type of ETF in Europe under the name of Vanguard FTSE World UCITS ETF. Alright, the time has come to summarize all the information and to give you my opinion on all of these investment options. Just before I do that though, if you're getting value out of this video, consider liking it and also subscribing to the channel with the notification bell so that you don't rely on the YouTube algorithm to serve my future videos to you. Okay, so we have those 4 investment options to invest in the market. But which one is the best? Well, unfortunately, there isn't a straightforward answer because each has its pros and cons. Let me just first give you my opinion on what the quote-unquote market is. I personally believe that describing the 500 biggest companies of one country, even though it is the richest and most powerful one, as the market is stupid. The same applies for even all the stocks in that country or all the stocks from the developed countries for that matter. If I'm going to be comparing an investment against the so-called market, I will be comparing it to the total world stock market, which in that case is the VT ETF. Now, it obviously depends on what you're trying to compare yourself to and what your investment process is. If you're only picking stocks from within the USA and that's your whole portfolio, then yeah, comparing your portfolio to the results of the S&P or VTI makes total sense. If you're trying to build a portfolio that is centered only around countries from the developed world, then by all means compare it to the MSCI World Index. But when someone says the market, in my mind, I always default to an index like the FTSE World All Cap stocks because it is the broadest possible one and you're not making any judgments or geographical choices. With all that said, I have often heard the argument that the S&P 500 is comprised of companies which are already global, and so it's okay to treat it as a global, not American index. This is an extremely flawed type of thinking. The idea of global diversification is to be able to have exposure to companies which are domiciled in other countries, not just where their economic activity is based. For example, imagine you only hold companies from within the USA thinking that you're globally diversified, and the Taiwan Semiconductor Manufacturing Company gets an even larger share of the chips manufacturing and grows even bigger. The fact that they will mainly be selling those chips to USA companies like Nvidia, AMD, Apple, and others does not help your portfolio at all because you have 0% in the company. Or following the same logic, when Novo Nordisk came up with its blockbuster weight loss drug, it might have been selling a lot of it in the USA, but since the company is incorporated in Denmark, if you only held the S&P 500, you had 0% participation in its monstrous recent rally. So, as you can see, it's not about where the company does its business, it's about where it is located. With all that said, let's now compare our 4 ETFs. I have prepared this sheet for you so that it's easier to visualize. Unfortunately, we cannot compare them with decades of data because when doing these comparisons, you are constrained by the most recently created ETFs. Because of that, I have put the 10-year returns. As you can see from the spreadsheet, the S&P 500 has the biggest returns, and the wider you start going, the worse the performance becomes. Have this in mind because I will explain what it means, and it's crucial for your understanding of the whole concept of investing in the market. This is also easily visualized here in Portfolio Visualizer. Now, when it comes to volatility, you can see pretty much the same picture. The wider you go, the lower the volatility becomes. The only exception is that it slightly rises for VTI ETF, which represents the whole US stock market. In my opinion, this is because it includes smaller and even micro-sized companies, which are a lot more volatile and vulnerable in recessions than the big ones, hence the bigger volatility than the S&P 500. So because of that, if I wanted to go only with a USA market index, I would probably choose the S&P 500. Now, the Vanguard Total World Stock Market ETF also includes small caps, but it has nearly 10,000 companies, so I guess this dampens the volatility. Okay, let's get to the meat of the issue and finally understand why there is such a return discrepancy. As I have very unsuccessfully tried to visualize with my ugly red arrow, the wider you go, the worse the results become. So you can see how the annual returns for the past 10 years for the S&P are 12.6%, and it goes down as you go to the right to the other ETFs, which also happen to be broader. If you're not able to grasp that concept, you will struggle every time you try to think about diversification and investing in the broad market ETFs. So here is where the secret is. Whenever you compare big indices, you must understand that the bulk of the returns in the past more than a decade now have come from American technology companies. I want you to imagine that the tech sector is a type of a center, and the further away you go from it, the worse your performance becomes. Yes, I know it's ugly, guys, but have patience here. I was never a good artist. The struggle is real. So looking at that masterpiece, I hope you can understand the concept that is behind the performance of all of the ETFs we already discussed. When you have a center that is performing extraordinary, it is logical that the more you introduce other sectors, companies, and countries, the more you will dilute your total return. However, because you are more diversified, you also lower your volatility and risk. And the best way to show that is to introduce another column to the left of the S&P in my spreadsheet. This will be the USA Technology Sector ETF XLK. You can see very clearly how the annual return of XLK is over 20% annually for the past 10 years, and at the same time the fund is way more concentrated and volatile with a standard deviation of 19.42% and a beta of 1.13. Also, the top 10 companies represent almost 68% of the fund, and it has just 68 stocks. So by looking at this, some of you are probably thinking, screw it, then I'll just invest in USA tech stocks. The problem with that approach is that investing is a forward-looking activity. You cannot base your assumptions only by looking at the rearview mirror. If that was the case, then the richest people in the world would be the statisticians. The big lesson here is different. A lot of people say that they invest in the market by investing in the S&P 500, and then they try to argue with you that there is no point diversifying outside of that index or even outside of the USA. What they don't realize is that their whole assumption is based on the outperformance of a very small part of the stock market of just one country out of the whole planet. So by investing in the S&P 500, you are not investing in the market, but are rather making a bet that the outperformance of the big companies in the USA, specifically in the technology sector, will continue. To me, although this is a very safe strategy and will probably work out quite well, this cannot be considered investing in the market, and it's only fooling new investors into thinking that they are optimally diversified. If you want to invest in the market and get diversification, then that means that you shouldn't be making any bets regarding a sector, a country, or even a group of countries to outperform the others. The moment you start making calculations that USA will outperform Europe and Japan, or that the developed markets will outperform the emerging markets, etc., I'm not saying that you are wrong, but you are no longer investing in the market. Instead, you are making assumptions and bets. Again, there's nothing wrong with that, and I do it all the time, but you should know what you're doing. Mentioning that, if you want some help on your investing journey and want to find out about my favorite strategy, then I invite you to my free investing masterclass, for which you can find the link in the description. Thousands of people have already attended it, and I have received overwhelmingly good feedback from them, so I'm sure it will help you as well. So to sum up, I personally believe that there is nothing wrong with having a thesis and investing according to it. This is the way I invest, and I'm certainly not 100% in the Vanguard Total World Index. However, I'm also not fooling myself that I'm investing in the market, and I'm aware that I'm making calculations, assumptions, and bets. If you believe the top companies in the USA will outperform, you pick the S&P. If you think there will be upcoming stars from the middle and small cap sector, but are still super bullish on the USA, you go with VTI. If you want to have broader international exposure, but you're not really sure about the emerging markets and the more unstable political and banking systems there, then you go with the MSCI World Index that only tracks the developed nations. However, if I was in the shoes of a new investor that is absolutely adamant on not making any assumptions and taking any sides, then to me, the only logical investment should be to invest in literally the whole market of the whole world. The moment you deviate from that, you are now trying to predict the future for good or for bad. Now, even by investing in the whole world stock market, you are again making the assumption that the stock market will continue to rise and that the global economy will continue to expand. Otherwise, you would have been in either cash, gold, or hiding in a bunker somewhere in the mountain. And so this is why I try to hammer into the head of my students in the dividend method program that getting out of the bed in the morning is a risk we all take, and you cannot live life without making assumptions and taking risks. With that said, let me know which of these ETFs would you prefer to invest in by leaving a comment below. Also, make sure you continue your investing education by going to the video that should have appeared on your screen already. It is the best way to make sure that you understand the risks that you inevitably need to take. I'll see you there.